The Ghana Revenue Authority (GRA) has rolled out major reforms to the value-added tax (VAT) system effective January 1, 2026 that fundamentally change how businesses calculate and administer VAT. These reforms are part of efforts to simplify tax compliance, improve transparency, and reduce the overall tax burden on consumers and enterprises. Under the new system, several important changes take effect that every VAT-registered business must understand to remain compliant and optimize their tax processes. 1. Unified VAT structure and total tax rate. One of the most significant shifts in the VAT regime is the move to a unified VAT system. The previously used VAT flat rate scheme has been abolished and replaced with a standard structure that clearly shows all components of VAT on receipts issued to customers. Under this new system, all taxable goods and services are subject to a total effective VAT rate of 20%. This is broken down into three distinct parts that must be displayed separately. VAT, value-added tax 15%. NHIL, National Health Insurance Levy 2.5%. GT Fund Levy, 2.5%. This means that when businesses issue invoices or receipts, the total charge to the consumer will be 20% above the net price, made up of these three elements combined. This structure aims to improve transparency both for consumers and for tax administration. 2. Abolition of the COVID-19 levy. Another major change under the reforms is the removal of the 1% COVID-19 health recovery levy from the VAT computation. This temporary levy, introduced during the pandemic, has been fully repealed. Its removal directly reduces the burden on transactions, helping lower the cost impact of VAT on both businesses and consumers. 3. Higher registration threshold. To reduce administrative burden on small businesses, the VAT registration threshold has been significantly raised. Previously, businesses dealing in goods were required to register for VAT if their annual taxable turnover exceeded GH 200,000. Under the new rules, this threshold has been increased to GH 750,000, meaning many small and micro businesses will no longer be obligated to register for VAT if they fall below this level. 4. Expanded input tax claims. Under the reformed system, businesses that remain VAT registered can now claim input tax credits on both the NHIL and GT Fund levies. This marks a key shift because previously these levies could not universally be claimed as input tax deductions. By allowing input tax claims on these levies alongside the standard VAT element, the reforms help improve cash flow for businesses and lessen the net tax liability they must remit to the GRA. This should encourage compliance and lower operating costs for enterprises that make frequent taxable purchases. 5. Sector-specific reliefs and incentives. The GRA has also introduced targeted adjustments under the new regime. For example, certain activities such as reconnaissance and prospecting in the mining sector will no longer attract VAT, providing much-needed relief to operators in that industry. In addition, zero-rating periods have been extended for specific products, such as locally produced textiles, which will remain VAT zero-rated through 2028. These sector-specific provisions are designed to support priority industries and stimulate local production. 6. Digital compliance and VAT administration tools. To strengthen compliance and modernize VAT administration, the GRA is expanding digital tools such as fiscal electronic devices (FEDs) for VAT-registered businesses. These devices assist with accurate invoice generation and recording, reducing errors, and improving record keeping. The reforms also include the introduction of a VAT reward scheme, which offers incentives to both consumers and businesses to encourage the issuance and collection of valid VAT receipts and invoices. This digital push is intended to deepen the tax base and make compliance easier for businesses. 7. What businesses must do. With these changes now in effect, the GRA has urged VAT-registered businesses to update their accounting systems, pricing structures, and invoicing practices. Businesses must ensure that VAT receipts clearly show all components of the unified VAT structure and that input tax claims are properly documented in line with the new rules. The authority has also offered support through its taxpayer service centers, toll-free lines, and official contact channels for businesses seeking clarification.